Hello and welcome everyone. Thank you for joining us for today's Baron FinTech webinar and a celebration of Baron FinTech Fund's 3-year anniversary. I am Liz Castle, Vice President for the Pacific Region for Baron Capital, serving the RIA, Family Office, and Bank Trust channel. I'm delighted, as always, to be here with my partner, Josh Saltman, Portfolio Manager for the Baron FinTech Fund. Josh has been with Baron for over a decade and has managed Baron FinTech since its inception at the end of 2019. Happy anniversary, Josh, and thank you for joining us.
Thanks for having me.
Before we jump in, one quick note. If you have any questions you'd like to ask during the presentation, please type them into the question box in your Zoom control panel or email them to questions@baronfunds.com and we can address them during our session. And of course, you can follow along with more information about the Baron FinTech Fund, along with all of our funds at www.baronfunds.com. Okay, to kick it off, 2022 was obviously a difficult year for growth stocks, and fintech names were no exception. Josh, what do you think are the major forces behind the pullback we've seen, and why were fintech stocks down so much last year?
Yeah, well, it certainly was a difficult year for equities in general and for higher growth fintech stocks in particular. So just with the numbers, the S&P 500 fell 18% last year, and the FactSet Global FinTech Index was down 34%, so meaningfully worse than the broader market. The universe of fintech funds that we track fell an average of 37% last year. Meanwhile, Baron FinTech Fund did a little bit better than our competitors, but was still down 33%, which was disappointing. I would say that fintech stocks suffered from the broad sector rotation from growth to value, as well as the relative underperformance of information technology stocks in general. IT was one of the worst performing sectors in the market last year, and just over half of our fintech holdings are classified under IT, so that was quite a big headwind. I'd say stepping back and looking at trends over a multi-year period, fintech has been a huge outperformer, really for the last 10 years. So after so many years of outperformance, valuations got a bit elevated at the beginning of 2022. So in a period when interest rates rose, which increased the cost of capital, that drove pretty meaningful multiple compression or compression in valuation multiples. I'd say, if there is a silver lining here, the good news is that most of the earnings outlooks for our businesses really didn't change that much from a year ago. And so the drawdown that we saw last year was really primarily driven by valuation resets, which hopefully are behind us. So if multiples stabilize and just stay where they are, then we would expect our stocks to appreciate at the same 15 to 20% rate of projected earnings growth. But as we often see, the market tends to overshoot on the way up and overshoot on the way down too. So multiples have compressed meaningfully, perhaps more so than we would expect in a more normalized environment. And so we could get some multiple expansion, which would accelerate share price appreciation, at least in the near term, above the 15 to 20% earnings growth that we expect. So meaningful valuation reset behind us. Stocks should at least appreciate alongside the pace of very rapid earnings growth, and perhaps even do better than that if we get a catch up on multiples.
That's great, thank you. And can you share with us any major changes you made to the portfolio over the last year?
So we always try to own the highest quality businesses in our portfolio, but we made a concerted effort, particularly early to mid last year, to upgrade the quality of the portfolio. So we trimmed or exited stocks that may have had really strong growth profiles, but less proven business models and less certain cash flows. and instead increased our weightings in more durable companies with strong balance sheets and free cash flow that could weather a higher rate and higher inflationary environment. So these are companies like FactSet, MSCI, Visa, and MasterCard. So upgrading the portfolio, I'd say, was the key change we made. We also added, particularly towards the end of last year, we added to our beaten down payment stocks. These are companies that have leading market positions and good growth prospects like Fiserv, Global Payments, and Network International that were being priced really as deep value stocks, close to 10 times earnings, whereas historically they had traded closer to 20 plus times earnings. And so they really pulled back meaningfully, even though their double-digit earnings growth outlooks persisted. So we thought there was great value there, and we added to those stocks. And then third, we also increased the diversification of the factors of our stocks that would benefit from higher interest rates. So a little over a year ago, I'd say the portfolio was very short rates and would suffer in a higher rate environment. I'd say early and mid last year, we made some changes and added to some stocks and added new names that would benefit from a higher rate environment. Not just a rising rate environment, but just a higher rate environment in general. Companies like LPL Financial, Charles Schwab, and Wise that are better able to monetize their idle client cash. We also added two names that had idiosyncratic growth drivers. Companies that were experiencing accelerating revenue growth or accelerating profitability, irrespective of what's going on in the broader economy. So a name we added in Q2 of last year was Progressive Insurance, which is benefiting from a hard insurance market. So whereas their peers are suffering from rising loss costs and inadequate pricing, Progressive just has better data and analytics, was able to pivot their business much earlier than others, and is now able to capitalize on rising premiums in the auto insurance market. So adding factor diversification to our portfolio, I'd say, helped us in a period of rising rates.
That's wonderful. That's good context. Along the same lines, we talked in the past about the distinction between what you categorize as winners and challengers in the portfolio. So I wanted to ask if you are still thinking in those terms, and has the balance between those two shifted at all recently?
So we actually segment the fund's holdings between what we call leaders and challengers. We think all of our stocks are winners, but yeah, leaders and challengers is how we bifurcate the portfolio. And leaders are generally, just to as you might presume, leaders are generally larger, more established companies with stable growth rates, higher margins, and relatively modest valuation multiples, whereas challengers are generally smaller, earlier stage companies with higher growth rates, lower margins, and generally higher valuation multiples on near-term estimates. The mix across Baron FinTech Fund has shifted more toward winners. That's related to my comment earlier about upgrading the quality of the portfolio. 18 months ago, so call it mid-2021, the fund was evenly balanced between leaders and challengers. Today, the mix has shifted more towards 2/3 leaders and 1/3 challengers. That helped preserve capital in 2022 because leaders significantly outperform challengers. Both categories fell in absolute terms, but the leaders meaningfully outperform the challengers. But it's a different market environment now, or it could be a different market environment, and we're looking to selectively increase our exposure to challengers today. Those stocks fell the most last year and likely will bounce back the most in a more optimistic market environment.
Got it. All right. Well, for several years, we've seen a tremendous amount of venture capital and private equity interest in the fintech space. But in recent conversations with clients and prospects, I've heard you say that that's not necessarily the case anymore. Can you elaborate on that a little bit and talk about the impact it's having on public equities?
Sure. Well, the amount of funding into fintech companies has exploded over the last decade. So total financing volume was just $9 billion in 2010, and it rose to $175 billion in 2021. So 9 to 175 billion, so up almost 20 times in a little over 10 years. All that funding went into dynamic new companies and has really expanded the investable universe of fintech companies. But it also increased the level of competition with existing fintech companies and created concerns about disintermediation, market share loss, pricing pressure. So there were pros and cons to all this flood of capital. In addition, with plenty of cash in the bank, I'd say plenty of the particularly privately held fintech companies had some undisciplined behavior, and they adopted a growth at any price mentality, led with price, which eroded profitability for everyone. Fast forward to 2022, though, the funding environment really changed. The VC funding across all industries fell by a third last year, while funding going to fintechs fell by almost half. And it worsened as the year progressed. So if we look at just Q4 of last year, VC funding into fintech companies fell by almost 3/4 on a year-over-year basis. So the funding has really dramatically pulled back for privately held businesses, which we think is ultimately a good thing for Baron FinTech Fund, really for three reasons. First, it just creates a more rational pricing environment, which should lead to better profitability across the industry. Second, the number of companies in the space will likely still rise. We're still seeing new startups in the space, a lot of focus on fintech as a category, given the very long runway for growth. But the rise in the number of companies will be at a slower pace. There will be less competition for capital and hopefully greater investor focus on the really exciting companies that already exist. And then finally, lower funding in the space should create an environment that's more conducive to M&A. Consolidation just makes a lot of sense in the fintech space, given tremendous synergies and economies of scale. The holdings in Baron FinTech Fund, the ones we have today, are very well capitalized. They have low leverage, plenty of cash in the balance sheet, and we should see more acquisitions by our holdings of earlier stage businesses that need capital and are less able to get it and are more willing to sell at reasonable valuations.
Wonderful. Shifting gears, let's talk about the thematic perspective. Can you touch on trends that you're seeing within the 7 themes in the fund? And along those same lines, have any new themes emerged and are any being replaced?
Yeah, so the fund focuses on fintech, but fintech is actually a pretty broad category. And so we created these 7 themes 3 years ago at the launch of the fund to better characterize the variety of subsegments within the fintech category. And actually, these themes have remained the same since the start of the fund 3 years ago. They're durable, haven't found a need to change them just yet, although that certainly could change over time. So I'll just start with one of our larger themes is the payments theme. And within payments, of a long-standing growth trend within that category is the secular shift from cash and check to electronic payments, and that remains ongoing. There was an acceleration of this theme, or I guess greater emphasis placed on digitization of payments during the pandemic. But since we've exited the pandemic and kind of returned to normal life, um, we're still seeing the same kind of pre-COVID growth rates, just off of a higher base. So we haven't given back all those gains that we achieved during the early days of the pandemic, which just makes sense because we're not going back to paper and analog processes. So we're just seeing this, kind of normalized levels of growth just off a higher base across many categories within payments, but specifically within the business payments category, or businesses paying other businesses. That the rate of digitization was extremely low, certainly much lower than it is for consumer payments. But with everyone working from home and people less willing to go into the office to write paper checks, we've seen an acceleration in the digitization of business. That's benefiting holdings such as Bill.com, Intuit, and Wise. Another trend within payments is the recovery of international travel continues. And that's benefiting the large card networks such as Visa and MasterCard because they earn more from international spending than they do from domestic spending. People getting back on planes, which they're doing, and spending using their Visa and MasterCard cards has been a big tailwind for those businesses. Third, in a period of higher inflation, that's been a modest tailwind to revenue since many payment companies get paid based on the nominal amount of purchase volume they process. And then another trend within payments is the shift from spending on goods to spending on services. So when everyone was stuck at home, goods spending went way up as people bought from Amazon and Shopify merchants. And then, in the last year, people, bought all the couches and clothes they needed and returned to spending money on services, going out to restaurants, going to the hair salon and getting their hair done. So that shift from goods to services has been disruptive for some companies, but it's been largely neutral for our payment companies. It really doesn't matter so much what people spend their money on, as long as they keep spending using their debit or credit cards, which they're doing. That's payments. Obviously, a lot going on there. The second theme is e-commerce. So e-commerce companies, obviously huge COVID beneficiaries, and then suffered in 2022 just as people returned to in-store shopping and we returned to more normalized levels of growth post-COVID. I'd say we're now back to the long-term trend line for e-commerce growth, and we feel better about our e-commerce businesses in 2023 and beyond. We should get back to, call it, 10% plus revenue growth, just as shopping trends normalize and people continue to spend online. But I'd say beyond just online shopping, I'd say there's a greater focus on omni-channel commerce. So companies like Adyen and Shopify, which fall within this e-commerce theme, they started solely online, but they're increasingly enabling purchases across channels, both in-store, through mobile apps, not just through desktop e-commerce shopping. So the ability to facilitate payments and shopping across channels really is a key focus. Third is enterprise software. So a variety of companies fall within this bucket, but across our software holdings, we're seeing a greater focus on cross-selling additional products and services to existing customers. So Intuit, which is a large holding, within their QuickBooks accounting software suite, they typically land with the accounting software and then try to bundle additional business services such as payments, payroll, and timesheets. FactSet, they will start with the desktop portal and then seek to bundle back office, portfolio accounting, and analytical tools. Jack Henry is another, which provides software to banks and credit unions. They typically start with the core processing software and then seek to bundle card issuer processing tools, so enabling small credit unions to process debit and credit cards. So bundling these additional services obviously, it increases the revenue potential for these software companies. It also increases retention, just makes for much more valuable businesses. Fourth category is information services, also a pretty diversified theme. But the rating agencies, S&P and Moody's, are great businesses with strong competitive advantages, but they underperformed last year because as interest rates rose, debt issuance volume went way down, particularly in high yield and bank loans. But financing needs don't go away, they just get deferred. And so I believe that there's a lot of pent-up demand for new debt issuance and refinancing existing debt. The year-over-year comparisons are extremely easy against very low levels last year. And I would expect a pretty rapid snapback in growth for S&P and Moody's starting in Q2. Same story with the credit bureaus. So Equifax, TransUnion, and then their close cousin Fair Isaac, which owns the algorithm for the FICO score. They faced headwinds last year from lower mortgage volumes and concerns that consumer credit trends would worsen. Mortgage volumes we know is cyclical, and that'll eventually come back. And consumer credit has held up much better than expected. So the earnings outlooks for those businesses have been partially impacted by cyclical mortgage, but their multiples are way down, and so feel very good about the near-term and long-term growth prospects and share price appreciation potential for our information services. Fifth category is capital markets. So some of the companies we invest in there are electronic trading platforms, MarketAxess and TradeWeb. They're really leading the digitization of fixed income trading. So fixed income as a category is way behind equity markets, much earlier in the process of migrating to electronic trading platforms. And MarketAxess and TradeWebs are the leaders that are migrating from phones to screens and really expanding the universe of potential trading counterparties to the entire world. So rather than just picking up your phone and calling Goldman Sachs or Morgan Stanley, you can access the entire market of fixed income participants through MarketAxess and TradeWeb. They save a lot of money for their customers while earning a small fee for themselves. So really attractive long-term growth potential for these businesses. But the stocks got expensive at the beginning of 2022. They derated and in certain cases faced some revenue pressure from the inverted yield curve. As more trading happened at the short end of the curve, they made less money from volumes. So also a cyclical phenomenon that we expect will normalize and expect accelerating revenue growth for those businesses this year and strong growth thereafter. Sixth category is digital IT services. So these are companies like Endava, Globant, and Accenture that build custom software for banks, insurance companies, and really a plethora of different businesses. And they grew very strongly in 2022, given the need to digitize that COVID really illustrated across the entire universe. But those stocks fell a lot due to concerns about a recession. I do expect that growth will slow from the hyper growth rates we saw shortly after the pandemic. So these companies before the pandemic were growing 20% plus organically. A few months after the pandemic, that accelerated to over 40%. Now we're getting back to kind of normalized growth rates of around 20% plus. Still very attractive. See a very long runway for growth in a gigantic market. But the stocks have really overreacted to this deceleration against tough year-on-year comparisons. I think the market is overreacting to concerns about a recession and what that could mean for demand for their services. And as a result, the stocks have derated massively. In many cases, they've gone from 50 to 60 times earnings, or call it 25, 30% earnings growth to more like 20, 25 times earnings for that same growth profile. Really like those stocks. They've derated massively, very long runway for growth. We own them across the firm. We own them in Baron FinTech Fund. Feel very confident about them. And then just lastly, the seventh bucket is what we call tech-enabled financials, which includes traditional financial services companies, banks, insurers, asset managers, brokers that are using technology in particularly differentiated ways to better serve their customers or operate more efficiently. And many of our tech-enabled financial holdings have done very well because they benefit from higher rates. We touched on this a little bit earlier, but brokers such as LPL and Schwab hold idle client cash on which they were earning next to nothing during a low interest rate environment. Now that interest rates are higher, both of those businesses are better able to earn interest income on that client cash. Same with Wise, which is a money transfer business that is increasingly encouraging or motivating their customers to hold cash in what are called Wise accounts, which are like bank accounts, even though Wise is not a bank. And Wise is able to earn interest income on that idle client cash and accelerate its earnings growth that way. So lots going on across the 7 different themes.
Yes, definitely a lot going on. And I think it's a great construct for digging into the different areas of the portfolio and understanding how you think about it. So thank you for that. An interesting topic over the past year has been correlation. Can you tell us about the correlation among your stocks? And is that something that you look to manage? And along those lines, how has it impacted your portfolio performance to date?
Yeah, so we have about 45 to 50 stocks within the portfolio at any given time. Right now, I believe the number is 47. And that those 47 stocks cover the 7 different themes, many of which have their own idiosyncratic growth drivers and seemingly should be more diversified than their stock price correlation would imply. I think what we observed last year is that even though we own a healthy number of companies across different subcategories within fintech, we saw pretty high correlation where many of them suffered in a rising rate environment. These companies generally are higher growth, generally have higher quality earnings and higher margins and better ROICs or returns on invested capital, but that generally comes with higher valuations as well. And so unfortunately, I'd say the correlations were higher than we would have expected in a bear market like what we experienced last year. I'd say we became mindful of that relatively early, and some of the portfolio changes that we made were intended to diversify our factor exposure and reduce the correlation amongst our different stocks. So it's never our intention to invest in companies that will only do well in a certain macro environment. As you know, and as most of the people on this call know, we are not macroeconomic forecasters or prognosticators. We seek to find businesses that have long runways for growth, sustainable competitive advantages that we believe can outperform over the long term. However, and I expect that's true for all 47 of our holdings. However, certain companies will prosper in a rising rate environment, and some will suffer. And so we sought to reduce the correlation across our stocks by finding stocks that would thrive in different market environments, had idiosyncratic growth drivers such as Progressive that could do well regardless of what market environment we're in.
Well, that's wonderful. Can you tell us within your companies, what kind of operational changes have they made in response to changing economic conditions, if any?
Yeah, so certainly a trend that we've seen across the tech universe in the last several months has been an increasing focus on efficiency, doing more with less, improving profitability, largely by cutting costs. And the largest costs for many tech companies are people. And so unfortunately, we've seen meaningful reductions in force or layoffs across the tech universe that really is just getting back to 2020, 2021 levels of staffing. Uh, Many tech companies way overhired over the last 2 years, um, became pretty bloated and are now cutting back and increasing efficiency. When I look across our portfolio, I'd say generally most of our companies did not dramatically overspend over the last couple years, and so they don't have to make big cuts now. I'd say there is increasing focus on efficiency and sustaining margins, particularly if we do get an economic slowdown. Um, but it's really only a select few that are really tightening expense discipline. And companies like Block, formerly known as Square, has expanded staffing and spent a lot more on new product development over the last few years. They're not so much cutting back or laying people off, but rather pausing the level of spending or slowing the rate of growth so that more margin expansion should show up. Basically letting revenue growth exceed that of cost growth, which should lead to better margin expansion. A select few companies are actually accelerating investments while their competitors are pulling back. So Adyen is a great example of a company that's been very disciplined on costs, while still generating very attractive revenue growth, and as a result enjoys very high margins, over 50% operating margins at Adyen. They slowed the pace of hiring during the first year or so of the pandemic because they just couldn't find the people in a very competitive hiring environment that they wanted at the compensation levels they were willing to pay. And so they slowed hiring when everyone else was overhiring. And now that the rest of the tech industry is laying people off, Adyen is actually accelerating their hiring. They are intentionally pulling back on some margins by spending more on growth investments because they want to capitalize on the longer term opportunities that they see across their business. Wall Street doesn't always like that. Wall Street loves to see high margins and expanding margins and doesn't like to see a near-term margin pullback like what Adyen is currently experiencing. But we take a longer-term approach and understand that these investments are necessary to extend the runway for growth that Adyen enjoys. And we would expect towards the end of 2023 and into 2024 for operating leverage to improve at Adyen. So seeing a few different reactions in response to changing economic conditions, but I'd say for the most part, our companies maintained discipline, and so they're either sustaining current spending levels while being cautious about any changes in the revenue outlook, and then a select few are actually accelerating their investments.
Got it. One more timely question, if I may, given what's been in the news for the past couple of months. Cryptocurrency and blockchain, both topics that come up frequently in our conversations. Can you give us an update on your thinking there? And for that matter, what are your thoughts on the bankruptcies we've seen across that space?
Yeah, well, I'll just start off by saying we have immaterial exposure to crypto in the fund. FTX obviously was a private company, did not own that or any of the publicly traded crypto-related businesses. even though we've been studying cryptocurrency and blockchain for years now. And I'd say that the FTX blowup really exposes risks in the crypto ecosystem and really the broader financial ecosystem. It also brought to light some of the mistakes that investors can make when they are motivated to invest at any price with either the inability or unwillingness to perform deep due diligence. So a lack of audited financials would be a no-go for us, regardless of how alluring or attractive an opportunity may be. FTX didn't have audited financials. So I'd say it brought to light the need for our deep fundamental research that Baron espouses, and also illustrated some of the pitfalls in the crypto ecosystem. We continue to evaluate the space, and so far, there are just limited real-world use cases for cryptocurrency outside of speculation, trading, and store of value. We continue to monitor the space, think that crypto isn't dead, likely isn't dead, could come back, but really we focus on customers, and we focus on customer value propositions in the businesses we invest. So just because a business is growing rapidly and is well regarded in the industry doesn't mean that they're solving real world problems. And so that's really what our guiding light is for investing in emerging fintech businesses.
Yes, thank you. And that is probably a good place to finish up with going to our broader outlook for fintech going forward. Could you tell us how you are feeling about the long-term prospects for fintech in general, and what you see are the biggest risks and opportunities that you can see right now?
Yeah, so I feel very positive about the fintech sector and Baron FinTech Fund in particular. Growth trends remain in place. We talked about those when we were discussing the 7 themes. The earnings outlooks for our businesses remain very strong. We expect our businesses to grow much faster than the broader economy, than the broader market. We view higher cost of capital as being a largely healthy phenomenon that instills greater discipline and a more rational competitive environment, and is leading to greater focus on profitability and sustainable growth. At Baron, we seek to invest in high quality companies with attractive unit economics, attractive growth prospects that are not seeking growth at any price, that have durable competitive advantages. So a more rational competitive environment, a greater focus on profitability and sustainable growth should be great for our funds. And after a year like 2022, which really is a year to forget and hopefully move past, but valuations are much lower today. They're much more attractive today for similar growth prospects and durable growth trends. So feel very confident in 2023 and beyond in terms of returning to attractive market-beating returns for fintech and Baron FinTech Fund in particular.
Wonderful. Thank you so much, Josh. I really appreciate you sharing your insights and perspectives with me as well as our clients.
Thanks, Liz. Thank you, everyone, for joining.
Yes. And I apologize if there are any questions we didn't get to during our call, but we will have your Baron representative reach out to you with an answer. And please feel free to submit any additional questions to questions@baronfunds.com. We will post a replay of today's call, and you'll be able to find the details on our website, again at www.baronfunds.com. I want to thank Josh again for his comments, as well as all of our clients for joining us today. More importantly, I want to thank you for allowing us to serve you, your clients, your friends, and family. I hope you can hear our enthusiasm and optimism for the fintech space going forward. And we'd love the opportunity to continue the discussion. Take care, everyone.